Hey everybody, good morning. Jason Russell here. I just wanted to record a video this morning to kind of really do a deep dive into what's happening in the mortgage industry today with all of this coronavirus craziness that's happening out there. And what I don't think is really being appreciated right now by the government, by the public at large, and even loan officers within our own industry is just how perilous a time we're currently in for mortgage lenders. We've always talked about 2008, 2009, that financial crisis that we went through was just a huge weight on so many lenders, and so many companies, you guys remember, went out of business and had to be, purchased by larger banks, etc. We're in a similarly dire type of situation in the mortgage industry right now. And I want to try and explain why. So the first thing I'm going to try and do is explain how the mortgage market works. So when you close a loan, whether it be a purchase or a refinance, the loan is then handled by a servicer. The servicer is the person who collects your payments, handles your impound account, is your customer service when you call in, etc. This isn't always the same company that you did your mortgage with. It can be a different company. But what's important to understand is even though that servicer is the one who sends you the statements, you think that they are the person in charge of your mortgage. In reality, they're not. What they're doing is they're collecting payments. They're collecting the payments and they're forwarding them on to a different investor. So that investor could be a government agency like Fannie Mae, Freddie Mac, Ginnie Mae, or it could be a separate investor. Basically what happens is you package that loan plus a bunch of other loans get put together and sold under what are known as mortgage-backed securities. And those mortgage-backed securities are invested upon in different things. So like you'll find your mutual funds, retirement accounts, insurance plans, etc., all have invested in this idea of mortgage-backed securities, which essentially is a group of you and 20 of your neighbors, all of your mortgages packaged as one, sold as an investment. But the servicer's role is really important because what happens is the servicer typically will pay the investor, so let's just say Fannie Mae in this case, will pay the investor about 1% of your loan amount up front. So if you're saying that your loan amount is $300,000, they're going to pay $3,000 to Fannie Mae up front, and in exchange for that, they are then going to receive a portion of the interest you pay every month in interest as income for themselves. It's typically a little over 0.25%. And so what that means is if I pay 1% up front and I'm getting about 0.3% in return per year, I need about 3 years to pay for that 1% I did up front. So the longer that someone's loan stays on my books as a servicer, the more money that I'm going to make, right? And so servicing can be a very attractive way of earning income as a servicing company. So I, as a servicer, want to do this as much as possible because I'm getting income from it. And a lot of times, rather than paying for that investment up front in cash, I will leverage it, right? So I might pay 50-50, right? So of the 1% that I paid up front, I may give half of it in cash and I may borrow half of it from somewhere else and pay it that way. And knowing I'm going to be able to make more money than what I borrowed anyway. And so I'm financing half of that cost up front. But what's important to think about is when rates drop really fast, there's obviously an incentive for people out who own homes to refinance their loan more rapidly. And so what happens is when a loan is refinanced, it's basically termed servicing runoff. And what that basically means is I am losing that 0.3% that I was gaining in income. And if someone refinances faster than that 3 years that it took for me to break even, I've now got a loss, right, on my investment. And the more loans I service, the greater the loss. So when I'm anticipating that I'm going to have a lot of runoff it's going to impact the value of my servicing portfolio. Now, what normally happens in a situation like this is I am going to lose money as a servicer over here because I'm going to lose this loan being refinanced. But as an originating firm, I'm going to make the money back based on the fact that someone's going to refinance. So that's why lenders love, if I service your loan, I want you to refinance with me, because even though I lost money over here, I'm going to make it back. That's what happens in a typical scenario. But what the coronavirus has essentially done, it has really impacted not just the interest rates, but also, as we know, an unprecedented amount of job losses. We saw this morning that they announced that 3.3 million people applied for unemployment for the very first time last week. That demolished the previous record. Well, now this adds additional risk, because in addition to all the other things we talked about, rates being lower, people wanting to refinance, etc., you have a group of people still in your portfolio that you service that are going to have trouble making their payments, unfortunately. And this is what's important to understand. Even though I, as the servicer, do not own the loan, okay, that's owned by Fannie Mae or some other investment, I have a responsibility to pay the investor anyway. Even if I have not yet received the payment from the homeowner, I have to pay the investor. Now, you can understand how this would be very difficult for a servicing company, because in addition to all my income going, not all, but a good portion of my income going away because rates are really low and people are refinancing, I have to start making payments to investors on my loans that are still sitting here, even though there's a good portion now of my portfolio who can't make the payments. So one of the things you've seen going around in social media is the fact that the federal government has granted what are known as forbearance, which basically is they've announced that if you're impacted by the coronavirus and you can't make your mortgage payment, we're going to allow you to forbear or move your payments backwards, just postpone your payments for X amount of time. But again, the servicer still has to keep paying it, even though the government has said, hey, we're not going to require your clients to pay it. So the government has said they're going to basically come up with a way to bridge the gap for servicers, but they haven't said what exactly is going to happen in the meantime. So you've got these mortgage companies or these servicing companies saying, well, I got to pay the investor over here. I'm not getting the income coming in from the other side, and you guys, the government, haven't come in to tell us how you're going to help bail us out to make sure we have enough money to make sure everybody's whole. So what that is all now causing, and I should also mention that the fact, whenever you have someone who has just taken a loan, so someone who closed a loan in February, their first payment would be due on April 1st. If someone defaults and does not make their first payment, that money that the servicer was expecting to get back from Fannie Mae when they sold the loan to them, the loan is ineligible to be sold. If there is a first payment default, the loan cannot be sold to Fannie Mae. So now that $300,000 that the servicing/mortgage company lent, that they were expecting to get back to lend to someone else going forward, they can't, because they have to hold on to the loan because we have a first payment default. So now they're basically, lenders are being required to dip into their own credit, right? Because they got to hold on to these loans. And this restricts the lender's ability to clear their pipeline and be able to lend it to the next people who are looking to do a loan, whether it be a purchase or a refinance. So what has this done to the market? Well, because of all these accelerated prepayments, people refinancing, the uncertainty that surrounds the possibility of people being willing to or able to make their payments, the value of a company's servicing portfolio has been basically cut in half. And what this has done, because the value of someone's servicing portfolio is a big portion of a lender's overall net worth, and your net worth helps to determine how much credit you have available. Many of these people, remember, I borrowed as the servicer, I borrowed some money up front in order to buy more servicing. Well, now the people I borrowed that money from are now saying, hey, I'm seeing that your servicing portfolio is not worth as much, and you're going through all these struggles. I want my money back, known as a margin call. So now you've got these margin calls, these lenders over here also asking for money, right? So as a lender servicer, I'm basically saying, okay, I've got to pay Fannie Mae over here, even though these people aren't making their payments. I've got to pay back the money that I borrowed to service more loans. I have less funds available because I've got to hold on to loans from first payment defaults. I've got less profit coming from my servicing side because those loans are getting paid off. I haven't yet made the money back on the refinances. So you can see there's just a lot of pressure on lenders right now. And the levels of money having to go out are massive. The other piece that I would mention is just kind of the unintended consequences that the government has done. So the fact that the Fed has stepped in, I talked about this on a previous video, the Fed has stepped in and basically said, I'm going to be buying all these mortgage-backed securities, right? It's known as QE, quantitative easing. And what this has done is this has, in general, helped rates move lower. Now, the thing to understand is when you lock your rate with a lender, all you're doing is the lender is promising to hold that interest rate for you for a period of time until your transaction closes. If rates get significantly worse over that period, the lender has to honor that rate that they gave you. That's the part of it being locked. Now, if in order for lenders to be willing to do this, because they don't like to gamble, they do what's called hedging their locks. So they're basically shorting mortgage-backed securities. So that way, if rates do go up and they have to honor that lower rate for you as a consumer, they're making that money back over on the other side because they've shorted mortgage-backed securities, and those two things kind of offset and wipe each other out. So the reverse is true as well. If you're locked and rates decline, hypothetically, the lender should be able to close your loan and actually make a profit because rates are actually lower and you decided to lock your rate at a higher rate. But the problem is because the lender shorted those mortgage-backed securities, they're losing a lot of money over there. Again, those things usually wash themselves out, and that's why a lock is not a huge issue. But what has caused the problem is the fact that the Federal Reserve has jumped in and buying an incredible amount of these mortgage-backed securities. And this is causing rates to move dramatically. And for those in the real estate industry who I've been updating on this, and the massive moves every single day are significant. And because of this, lenders hedged short positions on the MBS prices. They're huge losses. But again, lenders are saying, I'm going to make that back when the loan closes. But the shorts that they made on MBSs have to be paid immediately. They're not waiting for those loans to close and the lender to make the money back. So again, the losses that are happening right now with mortgage lenders, it's staggering. I mean, we're talking tens of millions of dollars. And this goes on top of all the other things we just spent 14 minutes talking about. So the best thing, honestly, the government is trying to come in and help. They think they're doing a good thing, but they're actually doing the opposite. And that's why a lot of people have been asking, why are FHA rates so bad? Why are VA rates so bad? Why are high balance loans so bad? Jumbo loans in a lot of cases. You're seeing non-QM lenders, things like where you hear stated income, things like that. Those lenders just went out of business, and they're not honoring locks that are happening. The reason for that is the fact that lenders have to throttle their rates and make them artificially high while in comparison to the things that normally control mortgage rates because of this. So again, when you add that to the fact that the Fed came out and said, we're dropping rates to zero. I talked about this on the other video, that how many emails, calls, texts I got about this. Well, for a lot of people, this is causing them to jump ship, right? So if you were locked at Bank of America at 3.5% and then rates dropped to 3%, and you, because you thought, oh, well, the Fed dropped rates to zero, I'm going to go to Wells Fargo. Well, now Bank of America is going to be losing a bunch of money because they hedged your lock. They shorted those MBS prices, right? And then expecting that you would close with them and they would make money on the other side. But instead, you left Bank of America, went to Wells Fargo to get that slightly lower rate. Bank of America loses a bunch of money, and Wells Fargo is hoping the same thing doesn't happen to them before they can close their loan. So there is just a ton of perfect storm type scenarios that are happening right now in the mortgage market. Honestly, the best thing that could happen for mortgage companies right now is for rates to go back up, because they need everybody to stop making moves at this point to give themselves, it's kind of like the snake that eats the, I don't know, whatever animal, and it's got to work its way through the body. Well, that's what has to happen for lenders, is they've got to be able to work this thing through the body so that they can make the money on the other end, so that all the money they're paying up front can be offset. And that's not happening right now. So that's why you're seeing some of these mom and pop shop mortgage companies go out of business, and your really well capitalized, well known lenders are managing to weather the storm at this point. But again, this isn't getting a lot of publicity, especially like on CNBC. You got people who are saying like, oh, things are bouncing back, it's going to be great. Well, it's not great right now. It may be great in 60 days, but for now it's not. And that's why one of the things I've been telling a lot of my clients, they're calling me going, hey, what's going on? I want to potentially refinance, etc. I'm like, give it 30 to 45 days. Because in 30 to 45 days, maybe a little bit longer, depends on how this coronavirus thing turns out. But in that time, I think that the animal will make its way through the snake, and lenders will start to be able to be in a position to offer rates that are in line with what the technical indicators are suggesting. And with that being the case, I think rates will go even lower if you're willing to wait. And I think it would be good for the mortgage market for you to wait, and it would be good for you to be willing to wait. So that's why the guidance that I've been giving has been where it's been at. So I know there's a lot of technical information, but I think it's really important that we in the real estate industry and just in the society as a whole kind of understand what's going on here, for those of you who are interested in this kind of thing. So again, long video. Hope you guys found it worthwhile and answers some of your questions as to why you're seeing rates where they're at and the market changing and those kinds of things. Any questions, please let me know. Have a good day. Stay 6 feet apart, socially distant, wash your hands, and just stay healthy, and just be kind to everybody out there, especially everybody that's really important in our supermarkets and everywhere else. Everybody's trying to do their best right now. So talk to you guys soon. Thanks.